I'm not a conspiracy theorist, but I do believe that um, sometimes timing is a little too coincidental. Like I said, the fact that this is happening early in a pre-election year to justify some form of stimulus puts us in the playbook, right? So I don't know. I mean, look, people might roll their eyes when I say that, and I'm not a conspiracy theorist by any means, but it's manufactured in the sense that uh, the headlines make it seem so horrendous, but we're down 3% off the highs for the S&P since this started. It doesn't make sense to me. The narrative is manufactured, I think, is probably the better way to frame it.
Michael Gade is an accomplished financial expert with years of experience in the industry, and we're excited to have him share his insights with us today. Toroso Investments, an asset management firm, employs Michael Gade as its portfolio manager. The firm focuses on providing financial advisors, RIAs family offices, and investment managers with ETF-focused research, investment strategies, and services. Michael Gade explains in this video the real reason for the recent string of bank failures. He also talks about the Fed's monetary policy and how April/May could be a pivotal month for the markets.
I think the problem is this is like everybody falling for availability heuristic, right? Which is that everyone's automatically thinking it's like 2008. Listen, throughout February, I was repeatedly tweeting in a very ominous way, March, 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 because the indicators that I follow were suggesting that you might have high volatility in March, right? Suddenly the banking, in quotes, crisis happens. You got a very sudden scare, right? The headlines look horrendous. And I kept on saying repeatedly that I don't think this is the credit event, which I expect at some point this year, that this isn't just something that results in a lot of wild gyrations. Volatility works both ways, both up and down. And that point about, people that say to me, well, it sounds like being flippant about just how serious this situation is. To your point, what's happening with Deutsche Bank and this kind of rolling series of where to focus the short attention on, it is very serious, actually. This is worse than 2008 from a financial crisis perspective if you play it out to the logical conclusion, which is why you can't bet on it, because leverage is so much higher than 2008. So they had to step in to secure the depositors. They had to do it very quickly. It was very clear. FDIC, the Fed, the Treasury, they came out with that press release. Now there's a lot of back and forth as to what's going to happen next. But I have to tell you, I always go back to, it's often the thing which you don't focus on, which surprises the markets the most. It's now very, very obvious that there's serious financial strain, but the market really hasn't gone anywhere. I mean, small caps have gotten hurt, regional banks have gotten hurt, large cap growth is nearly at new highs, all the money rotated out of banks into technology. So while it's serious, and we can talk about Deutsche Bank as well, I don't think it's anywhere near as cataclysmic as the narrative out there makes it out to be. Now, having said that, the problem with betting on the end of the world is you're not going to get paid for it, right? It's so serious that you can't bet on it. Just like, by the way, this is one of the reasons I was arguing for a melt-up. The conditions were there for a melt-up October 2nd, when everybody was screaming, fire. The bond market volatility was so high and yields were rising so fast that you would have had mortgage rates at 20% by November. You can't bet on that because that's a system reset. It's the same dynamic. It's the same argument here. It's just a different type of system reset. In this case, if you play it out to the logical conclusion, banking crisis, run of the banks, faster speed with which people can remove their deposits from banks, then what are we even doing talking about the banking crisis? Might as well learn how to grow food, because all they have to do is secure the deposits. Okay, done. Right, at least for now, that's done. Okay, and everything is too big to fail. I mean, at the end of the day, if it comes down to it, the entire world will just be J.P. Morgan Chase, and that's it. Right. So I think that's, in quotes, fixable given the money printer. But I think there are other dynamics that are happening. If you look at REITs have gotten smoked the last several weeks. There are a lot of very smart people that argue that we're on the verge of a commercial real estate crisis. Okay, maybe it's that. There's a lot of people, I think, that would correctly note that oil prices and commodities in the way they've sold off could be a precursor to a credit event, because a lot of high yield junk debt issuers are very leveraged miners and producers and drillers, right? My point in saying this is that it's never the obvious to focus on. So it's kind of like, here's the bird. Everyone's talking about the banking crisis. The market hasn't really responded. If you're going to have another bout of high volatility, which I think is going to happen in April, where directionally the market will go down, you could have a legitimate correction there, which would be risk off. Flight to safety trade is back. Thankfully, that's a good thing for my own funds, because treasuries are now responding counter to equity volatility. Then that could be sort of where the bears win for a moment in time. But this is the thing that people are not understanding. you can be bullish and bearish at the same time. So I believe we're in a melt-up scenario because we're in a pre-election year. I put out that tweet, got a lot of engagement. I said, how do you, pre-election years are historically the best year of the presidential cycle, right? The strongest S&P stock market returns historically happen in pre-election years. The theory there is, well, the existing party wants to stay in power, the president wants to stay in power, so what do? They stimulate. So how do you stimulate the economy with high inflation? With a manufactured bank crisis. Which, by the way, if you haven't noticed the balance sheet of the Fed, stimulus is now happening. The pre-election dynamic is there. So I do think you have a melt-up. It could be a volatile one. This is all known. People are making it seem like this is just suddenly out of nowhere. Credit Suisse has been failing since 2008. You look at a chart, it's been straight down, right? I mean, even with Silicon Valley Bank, the regulators knew it was in trouble. I mean, all this is now coming out now. It's not like this is like out of the blue. The timing, sure, you can say it's out of the blue, but that's what happens when you go through the fastest rate hike cycle in history.
Well, I believe a lot of big fund managers have owned Credit Suisse, not only stocks but bonds. PIMCO, I believe, being one of them. Over $100 million per fund of worthless Credit Suisse bonds. I don't think they knew, Michael. Otherwise, they wouldn't have held them.
No. I would disagree. I think you can know that the dynamics are poor. Well, I mean, that's the thing. They're not tightening anymore, right? I mean, just given the way the balance sheet has kind of spiked, they may want to go back to tightening. I think good luck. I put out a tweet. I think it was October of last year. I said, I think a year from now, meaning in October of 2022, it'll be very clear the Fed already over tightens. By the way, that tweet is not to pat myself on the back, but it's spot on. Why am I saying that in the context of now? Why is this regional bank stuff happening? Because they already over tightened. Because there's a lag between when they tighten and then the effects, right? Now, by the way, there's another interesting dynamic here, which I think plays into April. You always have to think about things from the perspective of where's the fat pitch? Right? Where's the area where you can get some real outsized convex type of movement, where it's very clear there's a contrarian trade to be had? You look at the speculative short positioning on treasuries, even despite this move the last 2 weeks here, there is so much bearishness on treasury prices, meaning betting on rising yields by speculators, that you can clearly make an argument that there's going to be almost an engineered short squeeze. Push treasury prices up, push yield lower on the duration side. Now, by the way, that's one way to fix the banking crisis, right? Because to the extent that a lot of this is driven by collateral that got destroyed because of rates rising at the speed they were rising, how do you fill that asset value gap against liabilities? You make the safe collateral, which is treasuries, worth more, right? So you have this really interesting dynamic, I'd argue, where the hedge funds and the speculators have made a killing shorting treasuries. As a result, the banks have gotten killed. Now the banks have to be saved. So what do? You flip the pain from the banks to the hedge funds. I always go back to it's not about anything except incentives. Those in power want to stay in power. Okay, so to stay in power, they create crises that they end up fixing and then take credit for. Politicians get voted in based on nominal, not based on real, because voters can't necessarily tell the difference. So there's no incentive by anybody that's in power, if you believe they want to stay in power, to let anything fall apart. Right, so the answer to your question is on the four horsemen. They've got snipers, right, to take the horsemen out because they want to stay in their cushy jobs. The elites don't want the system to break because it hurts them the most. Again, the path of how this plays out, you could have a melt up followed by a credit event, and I don't think this is it. I keep going back to my core thesis around this is, you have a lot of loans that were taken out at very low rates because of all the stimulus post-COVID. A lot of them mature on the corporate loan side in 2024, 2025. So most crises are refinancing crises, right? It's when they roll over that debt into higher rates where it becomes a problem. So you're going to have this kind of tsunami of debt that ends up getting rolled over next year into higher rates. Now, that could be a problem. A lot of these zombie companies may not be able to survive that higher interest expense. If I'm right on that it happens next year, the stock market and bond market needs to respond off of it this year, later in the year, right? That's where I think a credit event can happen, a VIX spike that could really flush out and end the bear market, officially. It's very possible you hit nominal new highs. Real new highs, I think, are going to be really challenging for the market for some time.
Let us know your thoughts in the comments section below. Thank you for watching this video on Market Empire. We hope you found Michael Gates' perspective informative and thought-provoking. If you enjoyed this content, please consider subscribing to our channel for more insights and analysis on the world of finance and investing.